All right. Hello and welcome to yet another value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have for the second time, my friend, Ben Claremon. Ben, how's it going?
I'm doing well. Happy to be back.
Great. Well, hey, let me start this podcast the way I do every podcast. First, a disclaimer. Everyone should remember nothing on this podcast is investing advice. Please go do your own work. The second way I start this podcast is with a pitch for you, my guest. People can go listen to our first podcast to hear the full pitch, but I just want to add on to it. You recently launched a competing podcast, which I'm going to forgive you for, but it's called Compounders Anatomy of a Multi-Bagger. I've really enjoyed it. You know, it's made me like you even more as an investor. You've had some companies on that I thought I was kind of the only person following, and you've had them on, and I just really enjoyed them. I've learned so much from them. You know, I would say for listeners, the StoneX one is a company that is extremely underfollowed. Go listen to that. I think you're going to really enjoy the CEO, the way he talks about the industry, creating value. There are a couple other, the Tigo one, everyone knows cable's close to my heart. I hadn't followed Tigo in a while, but I thought he came off incredible. So look, you interview small to mid cap companies, probably a little bit underfollowed. You interview the CEOs in depth, kind of like you and I are going to do right now for about an hour. So I think people should go check that out. That's my pitch for you. I realized that was a big softball one, but I just want people to know, check out the link in the show notes. Go check out the Compounders podcast. That very softball pitch out the way. Let's turn to the company we're going to talk about today. The company is Lumen. The ticker is LUMN. And I'll just flip it over to you. What is Lumen and why are we so interested in them?
Yeah. So I don't even know where to start. Let's start here. So this is a very contentious stock. This is a battleground stock. The derision that I receive whenever I bring this up with outside investors is high. So that can either mean that we are crazy and investing in something that is a value trap and won't make any money, or there's the opportunity for something to be underappreciated about it. We think it's the latter, but I recognize, and I didn't come on the show just to mess with people and pitch something very controversial. This is the largest position in the strategy that I manage. So, we own the stock, and it is a very important piece. So what is Lumen? So Lumen is the former CenturyLink, and CenturyLink is basically Lumen after the name change after CenturyLink, but CenturyLink was basically a roll up of telco assets. CenturyLink made before acquiring Level 3, made a number of assets. They bought Quest and they bought a bunch of other things. So the legacy CenturyLink business is and was mostly a consumer-oriented business. Think everything that everybody hates, declining wireline. So think phones, which, who in the world still has a landline these days? And so that business is a high cash flowing, high margin business that is declining at a relatively rapid pace. They also, within their markets, the old management team didn't really believe in fiber. So in the things that are doing well at Charter and Comcast, where people invested in a plant and are passing homes and signing up people for broadband, which is what cable companies now sell. They don't sell TV, they don't sell phones, they sell broadband. They didn't do that. So what you have is a pretty legacy rural telco that just hasn't been able to grow, and in fact has been shrinking. And so in 2017, they married that gem with Level 3, which is one of the largest fiber companies in the world. They have prior to some asset sales they're doing this year, they have about 450,000 route miles of fiber. That goes anywhere you want to go. That's APAC, that's EU, that's South America, which is an asset they're now selling, and that's North America. They are the backbone for a lot of things. If you go back to Level 3's history, it was a combination of Level 3 and Global Crossing. I wasn't investing at this time, and you can go back and read about those deals. There was a fiber glut, and Global Crossing, went bankrupt, and this is what came out of that. And so, they have subsea assets. They have transatlantic and trans-Pacific assets that we think are actually really compelling. But they're kind of buried within this business that, going back to 2017, probably should have never been put together. Didn't make sense to combine, literally like an old wireline company with a company that was the backbone of what our future technology was going to look like, right? And so how much of the world, especially in a COVID Zoom world, how much of our world travels on fiber? It's incredible, right? But so you have a very legacy culture, kind of like just like everything you can think about the old telco, merged with a more entrepreneurial company, which was run by Jeff Story, who's now thankfully the CEO of the combined company. But just a mess. The only saving graces was that there was a huge amount of cost savings between the two, all of which have already been realized. And so you have a high margin business that has not been able to grow, that was over levered, and really was an orphan because of all of the things that I just discussed.
Yep. Hey, but let me just start with a quick question. So CenturyLink, you had this old world, not rural, but old world telecom, lots of copper, lots of landline, all the DSL. And you said the old management team didn't believe in fiber. So I have two questions on that. A, sitting here in 2021, it's laughable that people didn't believe in fiber, right? So my first question was, A, why didn't they believe in fiber? Because I'm sure they had reasons, right? Even if you disagree with them, I'm sure they weren't just coming out there and saying it for no reason. And then B, it strikes me as strange that a management team who didn't believe in fiber would merge with Level 3, which is basically all fiber. Now that's enterprise fiber versus when I think you and I say CenturyLink didn't believe in fiber, we're more talking consumer fiber to the home versus enterprise fiber, but still a little bit of strange mix. So what do you think about those two questions?
Yeah, I mean, I can't go into the mind of the old CenturyLink management team, but here's what I can say. Our sense is that the wireline copper business was a high margin, high free cash flow business. They didn't really have to invest in the plant significantly to maintain it. And so, this was a company that paid a dividend, and, and when they measured Level 3, I believe that they inherited that structure. So I think this was more of this was not a management team that was looking around the corner. My guess is at the time, fiber was expensive, very, very expensive to roll out in their rural markets, right? If you're going to wire downtown Seattle or downtown Denver, there's a different cost than wiring the farmers who are 20 miles outside of a 20,000 person town, right? And so I think the costs were possibly prohibitive, and so maybe from an institutional standpoint, it just wasn't of interest. And look, I think why Level 3? Because Level 3 was a shinier, cooler asset than anything they had. And how many times have we seen companies try to get into the cooler space, right? They either missed the boat or, didn't have the right footprint. And so they try to buy into an asset. And then you get a culture clash where the legacy telco guys just do not know what to do with a very entrepreneurial organization that was a roll-up of a lot of different assets that was run by Jeff Story. And it was just typical, prototypical. It's like almost like AT&T buying anything. It's like they're just bound to screw it up because of the different cultures. And so I think that's a lot of what happened. And I will mention that we've talked to people who are close to Jeff Story, who's now the CEO, and he came on as COO originally. Jeff had a heart attack, I don't know, call it 5 or 6 years ago. Don't quote me on that, but within the last decade, he had a heart attack, and we think he was probably on his way out. This was his, not selling Level 3 for $34 billion, after building this thing. That's outsider kind of stuff, given where that thing came from. And so I think he was probably on his way out until he went inside and realized, oh my God, the guys from Louisiana, which is where CenturyLink was originally from, this is not going to work. And so that's why he's still here. But I think getting to that point, this is not, Level 3 was his baby. CenturyLink / Lumen is not his baby. He is not inextricably tied to this thing. And I think the recent actions would suggest to you that there are no sacred cows here. And we can talk about the asset sales, but
just going back, you said the CenturyLink guys from Louisiana, and as a New Orleans native born, I'm not going to take too much crap about Louisiana, but just going back to the old management team not believing in fiber, today it's easy to make fun of them, but I will say, look, he had a high margin business. And if you look at the fiber rollouts from the late 2000s to the early 2010s, you're thinking Google Fiber,
Yeah.
AT&T Universe, Verizon Fios. It actually did kind of prove out that all of them were overpriced and the returns on capital there were pretty poor. And I could see how, it's one of those classic dilemmas. You're a guy with high margin business and you're presented with this new product. Do you invest a lot of money, have to cut the dividend? Your board's probably going to fire you. Your investors are going to be screaming. And maybe it was just damned if you do, damned if you don't. But
I think that's fair. I don't think that's, I mean, you're right. In hindsight, it's really easy to make fun of them. I think there were a lot of other issues in terms of operations and how it was run, lack of investment. But yeah, that is, you make,
Jeff,
go ahead, sorry.
Oh, I was going to say, Jeff, the new CEO, if I'm remembering correctly, I should have checked the 13 Ds before I hopped on, but he was the CEO. He was named the COO when the merger went through. If I'm remembering correctly, I think it was Southeastern who filed the D that ultimately got the old CenturyLink CEO to kind of agree to retire in a couple months and Jeff to step on as CEO. So he's like a handpicked activist. Hey, this is the guy we want leading this company.
Yeah, I mean, I think Southeastern, and we have a relationship with Southeastern and talk to them to the degree that they can talk because they are a defiler, but we have and this is something we have an open dialogue with them about. Like, yeah, I think Jeff he's not their guy. It's not like they brought him in, but I think they believe in his North Star, that this is a guy who created an enormous amount of value at level 3. Right, sold it. Yeah, maybe. Yeah, could you argue that maybe CenturyLink was not the right buyer, and Jeff, got a really nice multiple for that business, and so this was kind of like his way, his swan song. I mean, that all of those things may be true, but that doesn't mean that he's not the right guy to continue to figure out how to create value from here. And so that's I think when I look at this, there's a lot of things that I think are misunderstood, and we can get into those. But if you know anything about Cove Street, and you know anything about me, like, I'm really focused on people's, like, what are people's incentives? What are their motivations? What is their North Star? Do they just, are they focused on EPS and I don't know, golfing, or they care about free cash flow and returns on invested capital and have, a private equity or John Malone style understanding of how to create value for shareholders? And I think Jeff does have those things. I will say that he doesn't always, on public conference calls or sell-side conferences, I don't necessarily know if he comes off as like, like Mauricio. You mentioned Mauricio Ramos, who's the Tigo CEO, who we've interviewed. Like, yeah, Mauricio, like he gets it, and he's not shy about it. Jeff's just a little more reserved, and I think people think of that as like some form of weakness or like a lack of conviction. We don't think that's what that is. So, these are the intangibles with any investment that, to get right and to make a lot of money, I think you need to be right about the business value and the people. We think we have the people here who understand how to create value. The market clearly does not think that. That is, like, I don't think there's any argument about that. And so if you're thinking about our contrarian position, it is that look at how he is incented. Open up the proxy statement and look at what the number of zeros he could add to his family's wealth if they could sell this company for anything near what we think it's worth.
Why don't we start there? How is he incentivized? So what is the proxy statement for those of us too lazy to open the proxy statement up? What is the proxy statement telling us?
Yeah, the proxy statement is telling us that his change in control is, what was it? I think in the $30 to $40 million range, but that was on a price, that was at a stock price struck at I believe it must have been struck whenever the proxy was issued. So, the stock is up a fair amount since then. And then if you sell it for what it's worth, those shares that you get in a change of control, or when your shares vest, right, you get the current value, not what it said when the proxy was struck. So, we're talking $100 million. Like, if you think that it's worth what we think it's worth. So, that's real money for anybody.
Can I provide a slight pushback there? So I don't disagree, but most CEOs of big companies have big change of control agreements, and that doesn't necessarily, just in my mind, it doesn't always incentivize them to sell, because when you sell, like, yes, you're going to get a boatload of money, but you probably already got more money than you know what to do with, your kids know what to do with. You get that on a yearly basis. And when you sell, you do lose the prestige of being the CEO. Your banker friends aren't going to call you up as much. You just lose a little bit of prestige. So like, I kind of have always like Charter, which is a position I've been involved with for a long time. When their stock was at 180, they set incentives that said, hey, if we can get to $500 per share within 5 or 6 years, which is an unbelievable IRR, our CEO will basically make $1 billion. So yeah, he'd get rich through a change of control and stuff. But even without that, he would make a lot of money. Does he have incentives there just to kind of deliver around anything like that?
I mean, there's nothing remarkable about their proxy that, right? Like, and look, there are puts and takes with that. Right?
Yeah.
If you incentivize people based on a share price and COVID happens, right, and your stock gets cut in half because of nothing you did, right, all of a sudden those are not going to get hit. All of that's underwater, right? So maybe the CEO stays, but what if that goes further down, right, into the organization, and all those people are not getting anything? So look, we can have an entire podcast on compensation and the puts and takes there.
One day we might do that. One day we might do that.
Look, I don't think there's nothing remarkable enough. Like the things they care about are adjusted EBITDA and free cash flow, and those are positive things for us versus, like, I don't know. There's plenty of other things, but this company needs to grow, right? If that, and it's where they failed. It's where, I mean, I'm as critical of not the execution, but of the outcome of this merger as anybody, right? Which is why I think they needed to be undone. But like, whatever it is, this company's not been able to grow, and that's both on the legacy CenturyLink side, and that's on the frustration that I have with the company, and the frustration that the market has with the company is that the level 3 side and the business side, that's Quest and level 3, they haven't been able to really move the needle either. And so that, I mean, that's really what's important for us as shareholders, and I think that team knows it. But to get to your question, you made a broad statement, and it is absolutely true that the change in control can be meaningless in certain situations. One way to make an enormous amount of money is just to stay in the seat as long as you possibly can. And so absolutely true. I just think that Jeff, given his age, given the heart attack, given that stuff, like, this is not, we're not going to see him in his seat in 10 years, right? There are certain things, not to talk about his health or anything like that, but just like, my point is, like, there are certain things that are suggestive to me that, like, he's not just going to want to sit in this seat forever. And look, maybe they hand it to somebody else, but from a personal perspective, when you're trying to figure out, does this person have the incentive to sell? And we can talk about Lionsgate too, because it's the exact same thing. Those gentlemen are getting to be in their late 60s, right? And so there's just there's a point, and I'm actually writing my Q3 letter to our investors, and there's this, I'm going to introduce the idea of a stock maturity, right? So bonds have a maturity, stocks don't, in theory, have a maturity, right? But there comes a time in the life cycle of a company where there is kind of a maturity. And I think both Lionsgate and Lumen are getting towards their maturity, where there are things being considered that may not have been considered 5 years ago, and there are outlets for value creation that are now on the table that weren't. And so that's really the idea. And we can talk about the things that have happened that are suggestive to me that there like things are in motion.
And I have found the best sign that somebody could be a seller or is a seller or something is their history. My favorite thing is a new CEO joins a company that's kind of in turnaround or something, and you go look at their background, and 10 years ago they joined a company, and 2.5 years later they sold it. Then 5 years ago they joined a company, and then 3 years later they sold it. That's the best sign. And here, Jeff, guess what? He already sold level 3 once, right? So I would say he's probably a willing seller. I want to dive into all the different parts and the complexities here, but I spent a lot of time in telecom. So let me just give you, when you and I were talking about doing a Lumen podcast, let me give you my background, because I think it's how pretty much every telecom investor looks at it, right? Once a year, somebody will ping me on Lumen, or I'll get around to look at it, and I'll say, hey, that's pretty cheap. It's in your wheelhouse. You've done a lot of work on this. Copper assets can be upgraded to fiber at some point. They've got lots of enterprise value, fiber that's valuable. They even talk a good game on capital allocation. Let's give it a look. And then I'll spend, half a day, whatever. And I'll say, oh, this is a mess. It's down 20% from when I looked at it. It's really hard to look at all the different pieces. I'm not sure what's going on. I'll probably just pass. And then A year goes by, I do it again. It's down another 20%, all that sort of stuff. So, I feel like I've been repeating this pattern. What would you say to investors like me who've been looking at this company and just saying it's a mess, it's too complicated? How do you get over that baggage for them?
Yeah. So you just defined a value trap, right? Which is like,
yeah.
Every time you look at it, it looks cheap, but it's down 20% at every time. And so let me say a few things about that. I would say, and I'll bring up Lionsgate again, with both of those companies, this long of consistent futility opens up alternatives and forces alternatives that were not on the table before, right? Our founder always says, like, what is the present value of your operating plan, and what could you get today for those for this company or these assets? And you weigh those two things as a management team. As we said, there's plenty of management teams who are inclined to just give it and to keep going with the present value of their operating plan and saying, well, this time it's going to be different and we're going to be able to grow and all that stuff. But I mean, they closed this in November of 2017. So we're coming up on 4 years since the deal. I think the stock was in the 30s. I mean, it's $13 today, right? This is, on a relative basis, it's a slaughtering, but even on an absolute basis, it's a huge, huge capital impairment that we've seen, right? And so that, to me, that is one of the reasons why this time may be different. And let me say the other thing that I think is really indicative of why things are different now. So when we first invested so we were level 3 shareholders, and CenturyLink bought it, we were out. And we looked at this, and I think Eugene and Jeff, my colleagues, were like, this doesn't make any sense. Like, we don't think, like, this looks like a really good deal for level 3 shareholders, and it looks like a really not a particularly smart thing. Because my guess is, and I'd have to go back and look, but my guess is they had the CenturyLink, given the multiple they were trading at, paying the multiple they did for level 3. That's like the multiple arbitrage you don't want. You're trading at a low multiple, the other one's trading at a high multiple. That is not what we call accretive, right? Because what happens is the good company's multiple, like the good company's earnings get mixed with yours, and all of a sudden the multiple for the multiple comes down, right? And so or the weighted average multiple is not particularly attractive. But anyway, so this company, so when we invested in CenturyLink and then when it turned into Lumen, right? This was a cheap stock. It was a small position. It was kind of like, we think the asset value is higher, but we don't have the conviction to say this is a 5 or a 7.5 or a 10% position, because it was kind of just like a mean reversion trade. Like, this is too cheap. Something will happen. If they can get the level 3 assets to grow, we'll make some money. It probably shouldn't trade at 5 times EBITDA. It should trade at 6. And, you benefit with a little bit of growth and mean reversion in terms of the multiple. Well, that hasn't happened, right? And so that's why we are where we are today. But what has happened is this company, I believe, and this is our contrarian position, is that this has become a special situation. So when Eugene and I, my colleague, were on the Investors Podcast last year, and I said the merger between CenturyLink and Lumen is and level 3 is being undone, everyone said we were crazy. The feedback we got was, we haven't, the company said, well, okay, we haven't said that. So let's remember that. And then every investor said, that's crazy. There's all these synergies there. Why would they do that? They just did this deal. And what has just happened, right? So for people who don't follow this, they just did a $7.5 billion asset sale of legacy CenturyLink assets to Apollo. And so the reason why this is a special situation is because I don't personally think, and I could be wrong, but I would say we have a pretty good track record over last year of anticipating some internal movement. I think that there's still something going on. There's one more shoe to drop, maybe two, right? And so the point is that this is a special situation. I firmly believe, and if you've heard what we heard secondhand about what Jeff Story said when he listened to that podcast, he said, these guys get it. And so our position is that this company will not be in the exact same form that it's in today in, I don't know, call it 36 months. Maybe it's 24, maybe it's 12, maybe it's 2 months, but in some time frame, hopefully within our investors' appetite to invest with us and hold this stock, that this will turn into, this will be a special situation where the value that we see in the assets will be realized in some form.
So let me step back for a second. There's just, one of the tough things with Lumen is there's so many different parts to it. And if we're going to go an hour, it's tough to cover it. But so over the past, actually, I was going to say year, but it's actually the past 4 months, 3 months, they've done 2 big deals. They sold about $7 billion worth of what I call ILEC assets. That's rural telecom assets, basically, to Apollo. Those were pretty much all copper assets that Apollo is going to buy, and they want to run, yes, milk it a little bit, but they want to run, hey, we're going to upgrade these copper assets to fiber, make them much more valuable. Fiber goes for $500 per home. Fiber goes for $3,000 per home passed. Copper goes for about $500. If you spend $1,000 to take a 500 asset to 3,000, hugely value created. That's what Apollo wants to do. Lumen sold those assets because they say, hey, we've got lots of other copper assets. We'll take these proceeds and we'll go make all of our other copper assets fiber. And those are actually better assets. And then the other deal they did was they sold a bunch of the old level 3 South American assets, I believe. South American assets.
Latin America, South America. Yeah.
Latin American assets that's all enterprise fiber. They sold it, I think, was to Stone Peak for about 9 times EBITDA. Yeah. And they're going to use that debt. So those are 2 big deals. I mean, we just did $15 billion in asset sales. But what you're saying is you think that there's more on the horizon. So what would more look like? What would another deal that they do look like? Yep. Sell the whole company, sell more old level 3 assets?
I'm not sure who wants the whole thing. I have some suspicions that there are people who would be interested in the enterprise fiber that level 3 and then Quest own. But I'm not sure who would want the consumer assets. So you could do it a number of ways. APAC. So the question is, what's left? So if you listen to Jeff Story's most recent presentation, I think it was at the Goldman conference. Yep. They talked to him about, like, is there anything left that's non-core? And he said, for sure, there are still things that are non-core. So what could that be? That could be the EU business of level 3. I think that is probably a pretty good business where they have a pretty good asset base of fiber. And so I don't know if that's non-core, but APAC, potentially, just like Latin America, these are all level 3 assets, could be for sale.
I tweeted out, I mean, he was pretty clear. He says Asia aspect, we don't own every part of the network. And then he starts comparing Asia to LATAM. I mean, I don't think he could have been more clear that Asia might be on the selling block. Yeah.
So, I mean, I think if you want to own both you need a bunch of endpoints. You don't just want to be a wholesale provider, I think. And this is, I'm parodying my colleague Eugene a little bit because he knows this whole industry better than I do. But, like, one of the reasons why Latin America was not a great asset for them is because they were just like a wholesale provider of fiber. They didn't have a lot of endpoints. It was just, and when you look at 9 times, you could be like, yeah, I mean, for relative to recent fiber multiples, that's pretty weak, right? Like, I mean, we've seen much higher multiples for fiber, but, like, I think Latin America and APAC are 2 of their weaker fiber holdings, and I think EU and North America are really core. So I think APAC could be on the chopping block as well. I don't know what multiple they'll get, but given what we're underwriting, you don't need a whole lot. But let me throw this at you. What would John Malone do if he was interested in selling the rest of those consumer assets? So what's left? So let's talk about what's left. So they basically sold, I would say, their worst assets. Now, if you read the Frontier presentation, they have very specific IRRs and costs per passed home for rolling out rural fiber in certain markets. And so there's a disconnect between what Lumen has said and done and what Frontier is saying. I think it appears that Frontier, maybe because they don't have a lot else, seems to believe that rolling out rural fiber has a high return. I have been told for years that Lumen did not see that math panning out. And so especially those assets that were sold to Apollo, I think fit that characteristic. Right or wrong, maybe fiber's right, and fiber being Frontier. Maybe Frontier's right, and there is a return there, and Apollo is going to do really well. And maybe Lumen's right, or maybe it's somewhere in between. But I think they believed that the ROI would not pan out on those assets. Okay. So they just sold those for 5.5 times. All right, so what's left? So what's left is 16 states, and they claim it's 70% urban and suburban, so only 30% rural, which the assets they sold are much more rural. You have really good markets in there. You have Vegas, I believe. You have Florida assets. You have Phoenix, Seattle. As my friend Eric Speron said, these are football cities. And so, these are good cities where they have dense fiber. If you looked at Denver, where where level 3 was based, that is a really nice asset all by itself. So my point being that these are attractive assets, and there are, according to them, 15 million homes that they could pass, right? And they haven't done a whole lot of fiber investing there. I mean, they have been, if you look at the only thing that's been growing in this business, it has been their broadband business. Now, it's not that big because it's a good question. Why haven't they invested more aggressively in fiber? Obviously, they inherited a situation where they were not well positioned because the previous management team did not align the company that way. But yeah, I mean, they said for years to some degree that we have the capital, we just don't think the returns are there. And now they're pivoting. And so you can question that, and you could say, that seems a little strange. Why, if you weren't capital constrained, why haven't you been investing more in fiber? Look, to some extent, the costs have come down, right? You and I have gone back and forth about this, and I've learned a lot, recently about how much the cost per homes passed have come down. And now with these two asset sales, they do have the money, I think, to simultaneously invest in the plant and pass these homes with fiber, pay the dividend, and generate a fair amount of free cash flow. So that's all good. But getting to my original point, they gave us almost no detail they gave us a very broad perspective. 15 million homes, 70% urban and suburban, nothing about cost per homes passed, where they were going to focus, the total amount they were going to spend. And so you can look at that a couple different ways. You could say they just closed two deals in 3 months, and everyone was just buried, right, and tired, and who knows if they had, who knows if they'd even, they didn't have anything to tell us, right? What they just did was to sell two assets, and that's
haven't even closed them yet, right? They've announced them but haven't closed them, so they're still probably going through a little bit of pre-integration, talking to regulators to get them to approve the deal. So not even closed.
So not even close. So yeah, maybe on the Q3 call or the Q4 call, we're going to get a lot more data about what these assets are, the 16 states that they're retaining. What does it look like to roll out the fiber? What kind of IRRs do they assume? So there's that. So you could look at their lack of detail in a number of different ways. The other way to look at it is, why would I tell my competitors where I'm going to be investing? Just go do it, right? As opposed to catering to the sell side and giving us way too much, giving us an information as investors to make us feel comfortable. Just go out and do it because there is we'll agree there's a first mover advantage in fiber, right? It's if you're the incumbent and you're the first one to pass a home, right, and you have that relationship, an overbuilder is going to have some ability to take that, but not necessarily a lot. But the other way to look at it is, if you thought you were going to sell those assets and they were on the block, you would talk them up all day, which is basically what they've done. They said, these are great assets. We've got 15 million homes to pass. The IRRs here should be really solid. We now have the capital to do it. We're going to build fiber, competitors, right? And so, look, I don't know exactly what remains non-core, but I do think there are other assets that could be sold. And when we get into valuation, I think that the margin of safety here is that all you have to do is put the multiples they sold, they're probably two of their worst assets for their worst consumer business and their worst business segment, which is Latin America. If you just put those multiples on the rest of the business, you have a multi-bagger from here.
Yep.
You don't need to assume anything other than that those multiples for their worst businesses, are fair for the rest of the business as well.
So we're going to talk valuation in some of the parts in a second, but I just want to finish up on your thought there. So they sold the assets to Apollo. They sold the LATAM South America assets to, I think it was Stonepeak, but they sold those. And then you think that they're kind of prepping the remaining consumer assets, the remaining copper assets, they're prepping it for a sale. And that could be to another private equity player. Private equity has loved, I mean, Apollo just spent $7 billion on these, right? Private equity has loved buying copper assets. They can upgrade fiber, infrastructure loves it. They could sell it to a strategic who's buying rural telecoms as a strategic. There aren't a lot of them out there, not because they don't want to, but probably because most of them, their balance sheets are a little stretched and the M&A history here is poor. So most of them probably just don't have that appetite, but it's possible. It's possible. But if they sold the remaining consumer business, what would the rest of the company look like? What would the assets be there?
You would have the business side, which, pro forma. I mean, there's a lot of moving pieces here. So like these numbers may change, but you'd have about $4.5 billion in EBITDA. I mean, who knows what it would look like, but something like $4 to $5 billion in EBITDA.
We don't even need number, but it would just be the old level 3 enterprise.
Plus Quest.
Say again.
So Quest level 3 and base. So legacy CenturyLink business, which includes the Quest assets, plus the remaining level 3, which is APAC, EU, North America. So you would have basically, it would be mostly an enterprise fiber company.
Which those go for, I mean, again, the devil is very much in the details, but I'm thinking back to Zayo, which went for like 13 or 14 times EBITDA. Stonepeak, I keep mentioning that they bought a lot of fiber assets recently, generally for around 20 times EBITDA. So we're talking about a stock that's
the Lightpath deal.
Lightpath deal, Altice sold Lightpath to Morgan Stanley Infrastructure. I think that was 14.5 times. And it's a good market, but that's a very low growth asset, if I remember correctly. So here we're talking about, hey, this is stock at 5. Obviously, we just said they sold 2 big assets. We're talking about them selling the remaining consumer and maybe Asia Pacific as well, but it's a stock at 5. And we're saying, hey, if you get isolated down to that core, it's 15. So let's talk valuation. I think one of the bull cases that I've heard here has been, hey, they just sold some assets. They sold the Latin American assets for 9x. They sold the Apollo assets for a little bit over 5x. The core business here is trading for about 5x EBITDA. And, the remaining business is certainly a better business than what they just sold to Apollo. So it's too cheap. Walk me through the too cheap math. What is this kind of worth and what are the parts there? Yeah.
I mean, I think you just summed it up really well, right? Like, so you have to believe, and this is just math, right? To believe that the RemainCo is worth, I don't even know what you have to believe to get to the current stock price. I mean, you basically, let me just put it this way. If you value the consumer side as pro forma, so assuming the Apollo sale goes through, assuming the Stonepeak sale goes through, if you value the mass side, which is, whatever, somewhere close to $1.82 billion in EBITDA. If you value that at 0 and you put a 9, which is a Stonepeak value on the business side, you get $18 on a $13 stock. If you simply put a 9 on the rest of the business, so the rest of the business side, so the enterprise assets, and you put a 5.5, which is the same multiple they sold the other, clearly the weaker consumer assets for. If you just put it, so just a blend, so 9 for the business side, 5.5 for the consumer side, which they call mass. That's assuming the proceeds come in, that's about $28 on a $13 stock.
$28 on a $13 stock. Whew.
So that's it.
It's well, I'm over here buying Altice and saying it's a $50 stock when it's 20 and it's going down 10% every day. But I like that method, that thinking. Let me ask. I've got a couple other questions here. First, there's been a lot of questions on the dividend. I think one of the things that has attracted a lot of investors to the story, at least initially, is the dividend. I think it's $1 per year, $13 stock. 8% yield. It has certainly yielded over 10% in the not too recent past. But when I look at that GS conference, I think that dividend, a yield that high for a company that needs to, that has said they want to do fiber to the home investments. They want to buy back shares because they think their stock's too cheap. I think that dividend's probably inefficient. And I think they've pretty clearly signaled they're going to cut it. But I guess there's two questions there. What do you think about the dividend? And, I always worry when you see a dividend cut, even if it's been telegraphed, people are just going to freak out and panic. So how are you guys thinking about the dividend and where it goes from here?
Yeah, I mean, the question you have to ask yourself is, what's your time frame? If you are living month to month, week to week, year to year, and stock being down 10% because of a dividend cut would be really painful for you, then you want them to keep the dividend. If you have a 3 to 5 year time horizon and have a corporate finance framework that is suggestive of being agnostic between a buyback and a dividend and whatever, paying down debt, or I mean, maybe you do have some opinion on that, but if like the short-term pain of a dividend cut is irrelevant to you for the long-term value of this company, then they should absolutely cut it. I don't know if it's to zero. I don't know if it's 50%. I don't know what it is, but they should absolutely cut it, and they should buy the crap out of their stock if you think it's worth $28, or they should pay down debt if they're really, if they're so worried, if people are really worried about a 3 to 3.5 times levered, telco asset that has some declining aspects of it, then pay down debt and get underneath it, or whatever, accelerate the 15 million homes that you can build fiber to, and then get the consumer side growing again, and then maybe the whole thing re-rates. So my point is, there are probably better uses for that cash than paying a dividend. There are a lot of people who would be really upset if the dividend got cut. I mean, if anyone's buying it for an 8% yield today, I think that's a wrong way to look at it. You should be looking at it as like, what is this intrinsic value of this asset at this very moment? And if we're anywhere near right about the intrinsic value, that would suggest that there are other uses, including a buyback. But of course, the buyback then it shrinks the share count, but then then you're using your cash as opposed to delevering. You're using your cash for that, and does that raise the leverage? Does it keep it leverage neutral? So what does that mean? So I think there's a tough balancing act here, because you've got people who truly care about the dividend. You've got people like who have the same sense of the SOTP that we do, that think, wow, you should be buying a lot of stock. And then there are a lot of people also, and there are plenty of your compatriots on Twitter who think that they should be investing aggressively in fiber, right? And then there are people who are worried about the debt. Those are 4 uses of cash flow, which are like, you can't do them all.
Diametrically opposed, yeah.
Yeah, and so look, Jeff and his team have a tough, there's a tightrope here, and it's not. And look, why did the stock go down? Like just like, irrespective of what we think, that Apollo deal was at a multiple higher than the stock price, right? So you sold your worst assets for a multiple higher than the stock price, and the stock went down. So what were people freaked out about? One, you mentioned the word dividend cut, and people, and there's a lot of short-term investors who are whatever, just want to front run a dividend cut and stock goes down. The other thing is, they give it, as we talked about, they give us almost no detail on what the fiber investment is going to look like. And our feedback to the company is just like, if you weren't going to tell us anything, tell us that, you'll tell us on Q3, and as opposed to going back and forth with the sell side analyst and just saying nothing, right? And so
say you're going to have an investor day and detail it all when you close the mergers. That's the pretty typical thing to do. Yep. And I know Lumen just had an investor day in, I think it was April or something, but just say, hey, we can't detail it now. We've been at work on $16 billion of asset sales, but we've got a good idea, and we'll give you guys a lot more clarity once these deals close.
Yeah, so that's why people freaked out. Look, I'm going to go back to Ben Graham, and I think one of the most important things Ben Graham ever said is that in the short run, the market is a voting machine, and in the long run, it's a weighing machine. And the short run voting machine said, yes, these deals make sense in a lot of ways, but I don't like the idea. I don't like the lack of transparency, and I don't like the idea of a dividend cut. And the stock went down. So I don't. Getting to really just drive it home, I don't care about the dividend. Yes, would it suck if my largest position was down 15% in a day because I cut the dividend? yeah, that would not be a fun day for us. But I think if there are better uses of the capital, if you have a 3 to 5 year time horizon here, you would rather them use it elsewhere.
Yeah. Look, I 100% agree with you. It's just one of those things, the me of 3 years ago would have said, just buy in front of the dividend cut. Screw it. Like the value's there. And I agree. It's a better use of the money to buy back shares or go invest in fiber. But the me of today says, oh, you know what? Like it's the old thing. Everyone knows earnings are going to miss, and then they miss and the stock's down 20% because it turns out not everyone did. And everyone knows the dividend is going to get cut, and they cut it and it's down 20% because there's a lot of funds that are in for the dividend and they sell. So I agree. It's inefficient, but it's a worry. And in many ways, have you ever looked at Q rate?
Oh, Q rate. Yeah, no, I mean, we're Liberty guys. So I've owned, off and on owned Q rate for probably since, when it was QVC, when it was a tracking stock. I mean, off and on since probably 2015.
I used to follow it very closely. I kind of stopped and I kicked myself because last year they announced anybody who's followed this, the company used to say, we're going to buy back shares like crazy. And then they ran into some headwinds. The business underperformed. And all of a sudden, they had loved retiring shares when the stock was 25 and the stock dipped to 10 and they stopped.
Yep.
And in the heels of COVID, they actually were a big COVID beneficiary. And they made a lot of money, and they decided to do this weird recap. They sent out a preferred share and they paid a huge dividend, which Malone does not pay dividends. That's very tax inefficient. And I know a lot of people said this is a special situation, get it for the return of cash. And I looked at it and I said, I've never seen this before. It feels to me like Malone and the insiders are saying, get all the cash out while the getting's good. Well, the stock's done incredibly well since then. So clearly I was wrong. But
but I think that was, to your point, that was a rebound. Everything was down. Everything's up.
Yeah, that's true. Yeah.
So look, the stock was like what, $5 or $6 at the bottom, and now it's what, 10 or 11. I mean, it's back to where it was, before COVID.
But it's 10 or 11, but they've also paid out like $6 or $7 of dividends. So you
really
have all your cost basis back. But
no, it's been a good one then.
Let me ask you a hard hitting question, and please, this is tough. So if I'm too far off, but I noticed when I was flipping through their 10K. So the US government to support rural internet provides lots of subsidies. One of them they provide is Connect America Fund that started in 2015. It ends at the end of this year, I believe. CenturyLink, Lumen makes $500 million per year from it, which I think is pretty much 100% margin. Now, some of that is related to the Apollo assets they're selling, but still that's a lot of money that CFA is gone. It's going to be RDOF, which is Rural Digital Fund, which I think incentivizes people to build out to rurals. But, that's $500 million of CAF money that I think it's almost 100% margin. It's going away. Yes, some of that's going to Apollo, but when I look at that, I say, oh, that's a really high margin cash flow stream that it's gone. So how are you looking at that, adjusting your models for that, all that type of stuff?
Yeah, I mean, we're assuming that 500 million is gone right and now. We don't know what percent is going to Apollo and what percent of that. My guess is, given the rural nature of the assets they're selling to Apollo, my guess is a lot of it's going there. And
when we say they're selling assets to Apollo at 5 times EBITDA, if I'm doing this from memory, that was trailing EBITDA. So that would include the CAF number. So if I added that CAF number back on a kind of run rate forward basis, we're talking maybe 7 times EBITDA. Am I imagining that, or am I thinking about that right?
Yeah, I mean, I'm not going to comment on the exact number because we don't know, but absolutely, your sense is absolutely right. Because if you look at, and let's be fair, you said you're going to ask a hard hitting question. Lumen did not do particularly well in RDOF. Now, I would say I'm a little unclear, and I think a lot of people are a little confused about what's going on with that. Like, they haven't really been sending out proceeds, because I mean, the auction, that thing happened last year, and there hasn't been a lot of movement there. We had a change in administration. There were a lot of complaints about the way that was handled. For example, the amount that SpaceX was able to get, right? Without even, they didn't, at that point, they didn't have a system, and they were able to get, I mean, now they actually have something, but then they didn't have it. Another one of our holdings, Viasat, has been very critical of that process. And I think Lumen looked at it, and if you look at like the way it worked, like there were people bidding. It was this weird auction where you actually bid how much you'd be willing to invest in a specific market, as opposed to like proceeds. from the way I look, from the way I understand it. And so there's been a lot of complaints about the way that process is, and it feels like the change in administration has slowed that down. So who knows? There was always going to be an RDOF 2. This was 1. There was always going to be a 2. Who knows if they scrap the entire thing? But in any case, you are 100% right that that isn't level 3 money. So let's just be clear here. This is not enterprise. This was the consumer side that is basically going to be less profitable going forward. But that's, as you said, captured in the Apollo numbers. And so let's just say that 250 or $300 million of that is going to be tied to those Apollo assets. And absolutely, that multiple is even higher, right? And so, I mean, and that's kind of what, if you look at Cincinnati Bell, which was a more fiberized asset than what the Lumen assets are, that went for 7.5 times in a bidding war. Right. Yeah. So there is a private equity demand for these assets. And listen, I should say something, because I'm a value investor and I always talk against my own book and I always have to look at the other side. It's like, my main worry is that, this is the definition of, whatever, a greater fool stock, where, you're just owning it, hoping that someone will pay a higher price for it, even if the fundamentals aren't there. And so, we've seen these high multiples that whatever, Cincinnati Bell went for a much higher multiple than Lumen trades at. And I would argue that at least the level 3 side of Lumen is far better than a lot of what Cincinnati Bell had. But look, this could be an outcome of the fact that we have a 10-year that's at 1.5%. And if 10-year goes to 3.5%, then infrastructure or fiber multiples aren't going to be what they were, right? And so it does scare me a little bit, and look, I think a lot of this is reflected in a $13 stock price, but it does scare me a little bit that Lumen may have a moment in time, and as an investor, I don't know if you consistently can make money hoping to sell something at an at an inflated multiple at a moment in time. So that's something I worry about. But then on the flip side, put a 9. Is a 9 an okay number? That seems like very few infrastructure-ish assets trade at that. So, but and you put a 5.5 on the other business, and you're getting $28, right? Or if you put a 0 on it, you're getting 18. There's a margin of safety. And so what I tell people when they ask me about Lumen, and I say, absolutely, all of these things you're saying are true. They've got problems with the copper plant that are declining. They've got businesses within level 3 that are not growing and that are shrinking. You've got a bunch of wholesale revenue that's going away. You've got legacy phone business even within the enterprise that's going down. So absolutely, all of those things are true. Talk to me at $18, and I may have a very different perception than at 13, right? Or at 12 or at 8 when we talked about it last year on the Investors Podcast. So it's like it's about margin of safety. And so, but to frame it, right? Like, I'm a Buffett style investor. And so you're like, what in the world is this guy doing with this? Like, investing in Lumen. It's because it's a special situation. And like, I think that people don't view it as such. People think that this company will be in some form in the same way that it looks now in 3 to 5 years. I don't think that's the case. And so, but yeah, the time frame matters, and they've got to hit the bid as far as I'm concerned.
Let me agree with you on one point and then push back on one point.
Sure.
So, I agree. I think investors are very much underrating, and it's one of the reasons I've been looking at everything telecom. They're underrating how much infrastructure money wants to pour in here. Yes. I can list. Cincinnati Bell was a massive bidding war. People forget. I mean, it was one of the best bidding wars I've ever seen. I wish I had been involved in the stock, because I had actually done a lot of work on it before. But if I remember correctly, it was Apollo bid. Brookfield came over the top. Apollo. I mean, it was like a 60% initial bid, and then there was a bidding war that drove that 60% premium up another 60%. So by the time it was all over, the stock had almost tripled or something. So, but it wasn't just them. Telco went for a huge multiple. There have been several other, Alaska Communications up in Alaska. I actually did play that one. I put a write-up up. People can Google it if they want. That went for it. Like, there is a lot of money here that is paying. You can go look at the multiples they're paying. And if you get with Lumen, with any of these guys, if you get the multiple that just the multiple people are paying, it's a big prop. Let me give a pushback though.
Yeah.
And I want to talk interest rates in a second too, but let me give a push at, I've done some work on Lumen. Before you and I even did the podcast, I read the Investor Day. I flipped through it. I followed it for a while. You mentioned Frontier earlier. The ticker there is FYBR. That's kind of the one that I've done a lot more work on, and I very much like it for all the reasons we've discussed here. So my pushback on your Lumen thesis, I think, would be, hey, I agree with you. People want to buy, especially the consumer fiber and actually the enterprise fiber, because we talked Zayo, we talked Lightpath and all these, but Lumen is just this mismatch of assets. So I don't disagree with you. The value might be there, but it's so complicated and so hairy. Like Frontier just emerged from bankruptcy, very clean story, trades for 5 times EBITDA. They're going to go do the fiber investment. They've laid out, they've been pretty clear. They've got wave 3 assets. They've got 15 million homes passed, of them about 5 million. They're pretty clear they'll look to sell into an Apollo-like deal if they get the thing there. So it's just a much cleaner story. Why is Lumen the way to play it? Because there's other, it's not just fiber, there's Consolidated, a couple other. Why play Lumen with all that hair when you can get kind of the same upside and the same story in a much cleaner story?
Yeah, I mean, I think it's a good point. I think in theory, you could make money on both. Yeah, and I'm not saying anyone.
I'm fingers crossed that we're both gonna make money.
No, and then like you and I will be high-fiving in 12 months or 24 months. I totally agree with that statement. I think internally, so you have to understand when you're an owner of an asset or an owner of stock, you have to understand like which parts of the business or which of the whole company that you'd be a buyer of and which parts you'd be a seller of. I think we would be a buyer of 450,000 route miles of fiber in the business side, and something that I feel like we could hold, if you could buy the whole business, something that you could hold as a core infrastructure asset. Yes, for sure, Google and Facebook are building their own fiber, subsea fiber across the Atlantic and the Pacific. But that's because bandwidth is growing at 30% per year, right? Like at some point we will run out of infrastructure and people will have to build more fiber. That was not true in 2000, right? Like why did Global Crossing basically go bust? Is because of that. Like there was an overbuild.
It's because they laid so much and there was no demand, right? So it was growing 30%, but it was starting off such a small base, and they laid it like it was going to grow 500% or something.
And so, but now we're in the opposite position.
Yep.
Like I just interviewed for our podcast the CEO of a global satellite broadband company, and if you've listened to this podcast or followed Kosher, you can guess who that was. But his point was that they're seeing fiber demand growing 30% year over year, right? Because video is such a bandwidth hog, right? And so for those assets, right? What I think of is infrastructure, which is going to be infrastructure. And by the way, I'll throw this out there, and it may be totally speculative, but I don't see why the next infrastructure like asset for someone like American Tower or those guys to own. I don't understand why fiber in the ground is not like a very obvious kind of like infrastructure asset to own in addition to that. So is that Crown Castle, or is it AMT? I don't know. That's just, I just see this as an infrastructure asset that is going to be core to our lives. And that's been, I think, highlighted by the COVID environment. So those assets I would like to own. I don't know that I want to own rural consumer assets. Like I've read the same presentations that you have. I've just been scratching my head a lot about the economics surrounding rural fiber builds. Now, I will say that we haven't even talked about the infrastructure bill, which could make, look, Frontier and Apollo, as they take these Lumen assets, might just get a windfall that whatever you think the return is going to be, like it's going to be even better because you're going to get government money. So maybe that makes sense. But the simple answer for me is twofold. One, I like the business assets. And if that's all we owned when the consumer assets were sold, or whatever next strategic move Lumen makes, I'd be okay with that. And if I could add part two, I think you really, the management here well, and I think you really like the management team. If I can put words into your mouth. No, the people part's the same. And I will throw one other thing out there, just because no podcast on a security is not is complete without a bunch of wild speculations. But this is something that we've actually talked to the company about, and that's the idea of turning into a fiber REIT. And so that did not make any sense when you had NOLs, because there's no reason, you can't use the NOLs if you're a REIT. However, if you look at these two transactions that just occurred, they will use
a lot of those NOLs.
All of the NOLs will be gone, and so they will be a cash tax payer to a large degree. Call it whatever, maybe 2023 or the back half of 2022. That's going to depress free cash flow. So the question is, what do you do with that? It is something that the company has looked at. One of the issues is that the fiber REIT, like, it's not really an asset class yet, right? There is that one, I forget the one, what it's called, but it's tied to the Windstream assets. Unity, but isn't Windstream like 40% of their business or something like that?
Well, so when they spun, I've got a lot of history with them. Windstream was 98% of their business when they spun, and I think it's still pretty high. They never got the multiple they wanted. There were some lawsuits there too. As I'm remembering it, that's a really complicated story. But
yeah, I don't think that's a fair comp. But like, if I'm an investment banker and I'm walking in and be like, you should turn into a fiber REIT, and I look at Unity and I'm like, that thing doesn't look like. But they've got customer concentration issues that Lumen would not have. Whatever the level 3, whatever you want to call it, level 3 plus Quest, whatever the main code, they wouldn't have that. And so, that REIT opportunity is something they have in their back pocket at some point. And as you know, like, REITs live in a different world because of that.
If I'm remembering correctly, Zayo, the white whale for them was always switching from a C Corp to a REIT, if I'm remembering correctly. And I think the attractiveness of that came and went, and there was some there were some operational issues there. But I guess for Lumen, the reason you like Lumen is you really like, you like the people, you like the valuation, but I think a core part of your thesis is, we really like these enterprise fiber assets, and the consumer assets we can kind of take or leave. Hopefully we get a nice multiple. We're buying them very cheaply, but you like those enterprise assets, which I can certainly understand.
But let's call them, they're not growing, so there's some wood to chop there to prove that these assets are something that you, as a shareholder, as a buyer of the whole asset, that's something that you want to own. Because, and I think this is my biggest criticism and concern about the stock is not that the copper business is declining. Clearly that's going to happen. It's going to continue to happen. It's that they can't get the top line for whatever reason. All of the reasons we've discussed about, like, declining businesses within the level 3. COVID sure hasn't helped anything, as SMB has gotten really hurt by COVID. But the strength of the enterprise fiber assets is only as good as your ability to get them to actually grow. And that has been the challenge. And if you they have done a ton to invest there. And I think for anyone who wants to not just be completely backward looking and try to understand what a path to growth would be for those enterprise assets, look at what they've done with investing in the edge. 97% of the country is now within 5 milliseconds of latency within of the Lumen plant. So, like, that opens up all kinds of opportunities for IoT, for like whatever cloud operations, like operating companies operating all wholly in the cloud versus kind of like a hybrid model. So there's just, they have a lot of different balls up in the air to get the enterprise growing, but 100%. It ain't happening right now.
We've talked about a lot. You've been super generous with your time. You and I talked for almost 20 minutes before the podcast started, and we're running over an hour now. But
yeah,
is there anything else on Lumen? Again, this is a complicated story. There's a lot of different parts there. We could have talked about a lot of other things. I've got so many notes over here I want to hit, but is there anything you wish we had hit that we kind of haven't covered so far?
I think as an investor, it's important not to get so in the weeds that you lose a sense of what the high level is. And so at Coast Street, we really focus everything in on 4 key variables. Mm-hmm. And you and I could have this conversation for 3 hours because there's so many moving pieces, but really there's only a couple of things that really matter here, I think. And the first one is the question of, what is this going to look like? What is the structure of the company? What assets will remain in, call it 24 months from now, right? So I think I put that under the heading of capital allocation. And so does Jeff Story, is he incentivized? Does he care? Does he know how to take a $13 stock much higher? Is it in the DNA of him and the management team and this company to figure out how to create value from here? Because if you read anything he says it over and over again that we think our stock is materially undervalued. So can they create that value, right? And I think that's the key variable. And look at and so to understand that, you have to try to understand the people. We've done a fair amount of work talking to former employees and people who were like, friendly with the former board members of Level 3 and who really have an insight on how the origin of what Jeff was thinking when he came to the company, and now kind of like 4 years in, what might he be thinking? So, I don't want to reiterate all we talked about, but I really just, if you can distill it down to those 4 key variables, which are capital allocation, I think ability to maintain a balance sheet that is not over levered. I think getting some growth at enterprise. Those 3, I think, are really what's going to drive the stock from here. And so, as opposed to spending your time nitpicking little things that they've done, which we certainly do, but instead of like worrying about how Jeff Story sounded on the conference call, or the way they fielded questions poorly, or their comments about the dividend, take a step back, look at the big picture, and make a call whether you think these people are value creators. And we have publicly, this is the 2nd or 3rd time we're publicly saying we think Jeff Story is a value creator. We think he gets it. And the moment may be fleeting, which is why we think they should hit the bid, right, in some capacity, at least to get down to a core that just maybe other people might appreciate relative to that problem, which I said is like, if you combine pretty good assets with really crappy assets, the really crappy assets are what carry the multiple.
And people tend to focus on the really crappy assets more than the good assets. Yep. Last question, and then we'll kind of wrap this up. When's Jeff coming on the Compounder podcast? I feel like he'd be a perfect guest, and it would be great for the company.
Yeah. So we're trying for sure. We are, we're still building our credibility. We're just about to launch. Next week we will be releasing our 8th episode. We've done 12. We've got some more momentum, which is great. To like bigger, more well-known companies, I think is like, I like a balance of like StoneX. No one knows who StoneX is. Sean O'Connor was amazing on that podcast. But also it's good to have some Fortune 500 CEOs on there as well.
Just get your casual Warren Buffett, just get your Bezos, just to get the numbers.
We're not there yet. But I do, I'm a mid cap investor. So to me, if I'm getting $6 and $7 billion companies on, that just shows that the podcast is resonating. Obviously, this is a complicated thing, and Lumen has been in a position where the Apollo deal is not supposed to close for another year. So they've got Hart-Scott-Rodino stuff they're dealing with. They've got regulators to deal with. So it's a question of how much Jeff could even say. And so we would love to have him on. I have tried to subtly prod Southeastern to figure out if we could like find a way to make that happen. But it'd be great. But you guys will be the first to know if we can do it.
Great. Well, hey, look, I'm going to tell everybody again, Compounders podcast, Ben's podcast, I'll include a link in the show notes. You really should go check it out. I've really enjoyed it. I've enjoyed it so much. I hit Ben up every now and then. I'm like, I'm looking at an interesting company. I need you to get the CEO on and talk to them, but go look at it. If there's a company you like, go check it out. Cause I promise you that you're going to learn a lot from the podcast. So Ben, 2nd appearance, really appreciate you coming on. Looking forward to the 3rd appearance. Looking forward to hearing your voice on the podcast again at a minimum. But thank you for coming on. I've enjoyed this, and we'll chat soon.
Yeah, thanks. And I hope I hope this has been helpful for people who are interested in Lumen, from giving some like a broad perspective and kind of like a high level thought. And I am sure there will be plenty of derision based on it, because that's just
based on my early Twitter mentions. At a minimum, faux Greg Maffei is going to be coming at us, but
that's good. Good.
I enjoyed it.
I'm willing to take it. I'm willing to take it. Thanks a lot, Andrew.
Thanks a lot, Ben.